Attempt number 2. We were live a second ago, but I don't know. It wasn't connecting. I don't know. I still don't know if it's connected now. Goddamn mining rigs. Fucking helium miners. I don't know if it's that. I actually run Bell and Rogers. I run 2 internet lines, so I can switch between Bell and Rogers in my house. If one network goes down, I have a backup network, and that's because I don't want to ever lose connectivity. So I'm trying the other network now to see if it's any better. It still says I'm offline right now, so I don't know. Someone comment if it's live. I don't know. It's saying it's not, but YouTube's been glitchy as hell lately, and I don't know what's going on. So hopefully we're live right now. I'm going to ramble until someone makes a comment and someone says that we are live. Okay, cool. We're live. This is take 2. So if you watch the first live stream, I don't know. Okay, people are getting in here. Okay, it looks like it is live. So jump off the other stream that I made, jump onto this one. It's recession time. We have had down days for the last 7 trading days in a row. Monday last week was the last update we'd had in the market. Tuesday was down, Wednesday was down, Thursday was down, Friday was crushing, Monday opened all-time lows, then Tuesday just added gas to the fire for a second, we had a little bit of a recovery, and then straight back down. And then today was also horrible for the NASDAQ. We are down 20% year to date. The S&P 500 is down 13% year to date. Almost the last 17 months of growth is wiped out. Let's pivot from, people are thinking, hey, let's pivot from tech and consumer stuff to commodities, and now commodities isn't even doing that well. I have half my portfolio is in dividend. Sadly, the TSX is not dumping as bad as other markets. True, and more than half my portfolio is TSX exposed. So for that reason, I guess I'm thankful. My overall portfolio, if you weight, I'm like 45% of my portfolio is exposed to U.S. equities and mostly tech. I want to make a juicy announcement. Facebook crushed earnings. You guys know that 1/5 of my entire tech portfolio right now is Facebook, and my average cost is like in the 170s. So now after hours, we were at 208 last I checked. We had a 19% jump after hours. I think tomorrow, if we have a good frothy day and Facebook's able to turn the market, in conjunction with there was good earnings on GM, great earnings on Microsoft yesterday. Facebook great earnings. PayPal over delivered on earnings again today. Google shit the bed on earnings, which was a down cycle. But Google also announced, for those people who follow, that they're going to be buying back $70 billion in shares. To put that in perspective, that's 4.5% of their entire market cap. Again, this year they're going to be buying back shares. So despite the share price being low on Google, I'm still bullish on Google as well. Large, big blue chip stuff is going to be solid, but it's been a rough 7 days. The average investor, if you're invested at the market, if you're trying to match the benchmark indexes, you'll find that you're down right now, big time. So I feel for you guys. I'm here with you. Year to date, I'm down like since January 1st. I think I'm down, well, overall maybe 10% or so. So it's no, thanks, man. Someone says you're looking buff. Hey, I've been doing a new thing. If you follow me on Instagram, you know I've been trying this new 75 hard. So I've been trying to get bigger, but I don't know. I'm really skinny, so it's the only blessing to that is that I'm perma rock 6-pack. But that's because I intermittent fast. For those people who are interested, without doing any workouts at all, you could literally just eat in a 7-hour window, 7 to 8 hours every day, and fast for the rest. Which means, like for me, typically like at 1 o'clock, and then from like 1 to 9 is my eating window, or like 2 to 10 is my eating window. So I never have breakfast ever. I just drink water, and then when I can eat, I eat whatever I want. There's no diet. I try to eat healthy, but like you can literally eat whatever you want in that window. It's impossible to overeat if you force yourself to eat in an 8-hour window. Intermittent fasting has tons of benefits. You got a level of clarity and ability to regulate your blood sugar better, less diabetes, less cancer, a whole bunch of other things that are great. But a side effect is that I'm 6-pack all the time. I don't put on a lot of fat because I eat in such a small window. It's kind of impossible. So thank you for bringing that health aspect up. Part of FIRE, the Financial Independence Retire Early movement, is centered around living your best life. And your best life is centered around being healthy, because wealth is important, but you have nothing without health. So it's important to take care of yourself. I personally am trying to grow my wealth to a billionaire level in the next 40 years so that I can live to be 150 or 200. The average life expectancy continues to increase. And for the wealthy, what you see is if you look at the higher socioeconomic statuses, typically 90 is the average life expectancy, and that's increasing at a faster rate. So the richest people, good question, Patel. I'm going to give you my read on real estate in a second here too, both in the US and in Canada, high level. And I'll answer your question too about cheap stocks I saw pop up there, and any other questions that I missed, I'll hit the Q&A section in a sec here. But I'm just going to readjust my chair. Yeah, it's one of those things where health is everything. So I just want to cap that question with like, don't forget about your health in the pursuit of everything else. And I say that, but like last night, my kids kept me up, and early this morning kept me up, and I had like maybe 5-6 hours sleep. It's the worst amount of sleep. I target 8.5 hours every night, even if it means getting a nap in. Today's one exception to that. I'll probably sleep 11 hours tonight, or we'll call it 9.5 hours, maybe with one interruption with my daughter in the morning. But I'll do that in order to recover, because sleep is important to your body's health. It's important to all of that. So yeah, back to recession. As of today, there were some amazing options contracts you could write. You could sell 110 Facebook puts, meaning Facebook has to drop below $110 a share to get assigned. Otherwise, it's money for nothing. And it was paying like 60 cents or something a contract, which isn't per share. 60 cents a share, expiring Friday. Like for 3 days, the annualized on that is like, if Facebook doesn't drop 30% between now and Friday, you make like a annualized like 50% or something. I forgot the math on it, but I remember thinking like, Jesus, this is insane. Like my brain was just blown about how great deals were today on Google, Facebook. Look at all the tech names were just destroyed. And there's just some insane value. Could it go lower? Yes. Might it go lower? Yes. We are officially, on the NASDAQ, we're officially in a recession. Netflix down 45%. Facebook was down 49%. PayPal down 70% on the year. Name a stock in the tech or consumers industry, and it's down on the year. Everything from Amazon to Google to everything, just destroyed. Now, real estate. Switch gears for a second here. Pause that. I do think that the minute that the government sort of eases up on the tightening and the rate hikes, we'll see an explosion in tech and in growth. And so there is value there. If you have a long enough time horizon, it's okay to get into those plays now. Like I'm into margin now a little bit. I couldn't resist today on Google, PayPal, Facebook, Amazon, a whole bunch of tech names. It's like I just can't resist buying a little bit of stuff on margin. If I have to hold it for a year, I will. That said, I'm currently trimming in the dividend stocks. The reason I'm trimming my dividend stock stuff, and 55% or so of my portfolio right now is blue chip dividend stuff. Like we're talking like Pembina, Enbridge, the financial sector, like Fortis, and like a whole bunch of other type utilities and all that kind of stuff that pays a nice solid 5% dividend yield. And you're like, 5% is great. It was great when I could borrow at 2.5% interest, but now interest rates are coming up to 5%. And so my yield is close to my cost of debt on my margin. And I'm like, you know what? Like if I can't borrow against my portfolio and have the dividends cover the interest, I probably don't want those plays. When bonds, some of the safer bond plays, government bond plays in the US right now are paying, like 8% in some cases. Why would you want to be in a dividend stock paying 5% when you can get 8% from bonds? Or you can do private mortgages and make 10%. Like it just, in this inflationary environment, I think people are flocking to value and they're flocking to dividend stuff. But I personally think that, I don't know. I don't feel so great about some of the dividend stuff right now. So I'm pulling some of that back. I'm up a lot, like 20% in the last year. So I'm like, that part of my portfolio is doing really well. I'm going to trim some of that, pull some of the fat off, and keep it there to deploy into tech and other things. Maybe it gets worse. Maybe it doesn't. I don't know. But yeah. Okay. So William says, great call on Facebook, almost $200 in a down market. Yeah. So I'll probably clear, like if tomorrow becomes a euphoric frothy day of like plus 25% on Facebook, I'm going to trim half of my position tomorrow. I have $1 million position in it, so I'll probably sell $500,000 in my contracts. And I'm on, it's all options contracts, so I'll get a huge bump tomorrow. A lot of it's calls and puts, so I'm not straight equity, so 25% on the equity side is going to be like 50% probably on some of my options contracts. They'll get, pretty insane tomorrow. There'll be some irrationality in the market. If the day goes how I think it's going to go tomorrow, there might be an opportunity to peel back and to prepare, because there will be, in my opinion, we're going to have some worse times ahead. And so when you make a great trade and you lock in some profit, it's okay to take some off the table and to be in cash. There will be more opportunities in many stocks throughout the year. Just Boeing destroyed too, like down 12%. Everything I've been looking at, just you pick a stock in the US right now, it's getting obliterated. Mortgage rates in the US in December, end of December, we're talking 4 months ago, January 1st, I got quotes at 2.99 to 3.24 for some US property mortgage quotes I was getting. Today, 6.99 to 7.4% as a Canadian buying in the US. Interest rates are up 250%. Your mortgage payment qualifying goes from, if you qualified for $1 million house before, you now qualify for 600. That is going to have effects. People are bringing out numbers, and I watch all these gurus. There's like half a dozen I follow in the US. There's a couple I follow, in the UK. There's a bunch in Canada that I follow too. And almost all of them that sell courses and are trying to raise capital and trying to pump their thing are like, real estate's great. It's awesome. Like, we have a supply demand issue. They're focused on like that supply demand curve challenge that currently exists. And they're all rah, real estate's fine, keep buying. And I'm like, don't not buy real estate if there's a good deal that falls in your lap. It's a business like any other. Now's the time where you can carve out some great deals. So I am still looking to acquire. But, the average property, in my opinion, is going to fall, if it hasn't already in your market, 10 to 30%. In Toronto right now, they're down 20% in many pockets. London's down 10% from the frothy highs of February. Month over month drops double digits right now, every month, both March and April. We don't know how May's going to go. I think there'll be my prediction, as I said a few streams ago, is that the low interest rate locks that people have, like they've got pre-approved already, and they've locked in a certain amount of whatever their rate is for 120 days or something. They're going to want to use that. And so everyone just waits at first. The first like 30 or 60 days after rate hikes, they're like, let's just see what happens. And so nothing really happens. Stuff gets stale. But then the people with the rate holds are like, geez, like rates are going up to say 4% in Canada now, and they're going to creep even higher. Should I lock in at 3%? The deal cash flows, it makes sense. There's value add here. Or let's just say it cash flows. And they're like, forget the value add piece. It cash flows. I want to buy this. Lock it in now before the rates change. So people are going to start locking things in. That'll create a small spike in the real estate prices. So if you're looking to offload some properties, May, June are going to be great times to do that. I'm going to offload 6 more rental properties then. I'm sort of waiting right now. I've got feelers out there. I got my 6plex that we've gotten offers on it, but nothing firm. The other property, again, on Emery there, it's a duplex. We're just renting it out. Same with the 6plex. I'm renting it all out. If I have to hold it, it's cash flow positive. I'm not worried. If there's an opportunity to sell, I could take that capital and redeploy it somewhere else where I think there's more value. I'm expanding into the U.S., so keep an eye on that. I will be expanding into Texas and into Florida, maybe Arizona as well. Florida for sure, maybe Texas, maybe Arizona. There's opportunity there, especially where cap rates start to creep back up to set. We were looking at many cities in January, in February, we're looking at like 3 and 4 cap rates. We're starting to become the reality. At 7, 8, 9, 10 cap, I get more interested. If interest rates do creep up in commercial to 5 or 6%, you still have positive cash flow. If you can negotiate a vendor take back where the vendor maybe finances 60% of the debt for the next 2 years until rates calm down, you might be able to take a deal down at a lower cost of debt than with the bank, because the private lenders, or the vendor themselves providing the private lending to you, they believe in the building, they know about it, they just don't want to manage it anymore. You can take over some headaches right now. There's not as much competition. Where there was 10 offers on a property, now there's nothing on offer date. And you could slide something in at 80 cents on the dollar and it might get accepted. Or 100 cents on the dollar, but hey, you're going to finance 80% of this deal at 3% interest. And they're like, oh, I'm getting the asking price I wanted? I was thinking I was going to have to take a 10% pay cut. The seller's now like, okay, I get the price I want. All I have to do is just finance you for a year. Okay, I believe in the property, no problem. So you give them the price they want, but then you get to negotiate the terms that you want to get into that deal. And the hope is you can refinance them out when interest rates come back down, because they will. If they keep cranking on the interest rates and they keep tightening, guess what happens? Inflation comes back down, right? It's eventually will happen. It will be painful to get inflation in check, but the government will get it into check to back down to 3%, which is their target. Their goal is to devalue the currency to nothing over a 200-year period, right? Like by 2200, the currency will be worth nothing because they're going to crank inflation compounded at 3%. That's their goal. That's how they get out of the debt. That's how they continue to raise capital through tax revenue. Inflation inflates your assets, and then they can tax it, right? So they want inflation. Inflation is a good thing. They don't want as much inflation as we have right now. We have too much inflation. So we definitely need to get inflation under control. And they're doing that. Like it's still going crazy, but now what we're seeing is a contraction in the market, contraction in the real estate market, a contraction in business right now. A lot of the lenders right now are the phones aren't ringing. It's the mainstream media isn't talking about it yet, but when you talk to people in industry, what you're seeing is when we look at supply demand in Canada as an example, people talk about supply demand issues. Yes, there is. There's a supply demand issue of about 7% a year. So over the last 3 years, we should have seen real estate grow supply demand plus inflation. So let's call it like 7 and 3, 7 and 2, and 7 and 10 for this year. That puts us like a 40% increase. Real estate's gone up 120% over that same 3-year period. So we're 60% higher growth than supply demand plus inflation. So there's a correction that needs to happen. That growth was due to stimulus money printing and low interest rates, forcing cap rates to all-time lows and values up. When interest rates come back up, that will correct over time. And so we will see a pullback. Like where a house was selling for at the frothy peaks in Florida at like end of February, at the frothy peaks in Toronto and London in February of this year, where things were selling, let's say for $1 million, that house will creep back down to 800, which might sound like, oh my God, it's back down to 800, but that 800 is like where it was a year ago. So we're not erasing massive amounts of it's a crash, like a 30% pullback in real estate is a real estate crash. But for all of us investors who have been in the game, we're going back a year ago. That's what 30% does. It takes us back a year. So it's like, I don't know, it's not, I don't want people to think like, hey, they need to like worry that the world's going to end. No, it'll be fine. And like in 5 or 10 years from now, the prices will still be attractive. They'll be higher than they were now. Most likely, there's a very, very high probability of that. So I'm still bullish. In fact, I just put an offer down on another farm between London and Sarnia. We're working on another farm near Kingston. I'm buying land plays. I still believe in the Airbnb plays. I still believe in plays where there is value add and where you can produce positive cash flow that more than covers all the expenses. That said, I have properties that are completely turnkey, which doesn't fit my model. Or I have partners that want to get paid out. Or I'm like, hey, I could take this capital off the table. My sixplex as an example. I have a ton of equity in that property. I think we have like $800,000 in equity in that property. I want to access that. One option is I go with my bank and I go through the refinancing and I give them all the lease. I get it all rented, take it to the bank because I can't rent it vacant. Or I can't refinance it vacant. Sorry, I have to rent it. So I go through the work to rent it. Once they're all rented, it makes for an easier sale too. So that's why I'm going through the process of renting it now. And it becomes cash flow positive. So I'm not holding something that is cash flow negative. But in that example, I go back to the bank, I pull a 75% loan to value, tax-free pullout, but I have to go through I have to send them all my bank statements. I have to send them my tax returns, my leases, whatever they ask for, property statements, everything on all the properties. It's a lot of work. Whereas selling, it's easy. And I get all my cash out. Not 75% of it, all of it. Less the tax implication, of course, with that. But it's just a lot of work to go through refinance, to go through the appraisal, and all the work that goes along with that. So I'm indifferent. Part of me is like, I should sell the property, cash out. My partner on the property wants to cash out. I could refinance it and keep it. I could go either way on that, but I hear that too. People reach out to me and are like, hey, does it make sense to sell right now? Does it make sense to, refinance? I think this, if you have property right now, refinance or sell, one of the two. If you love the property, you want to keep it, refinance it. These are going to be the best appraisals you're going to get for the next few years. There still are great comps that are closing that sold in January. So there are some really amazing comps. You get some great valuations. Potentially, those prices can come down 20%. You might be able to pull out 100% of the value of the property 6 months from now. And that's a good thing because you can borrow right now still at, well, in Canada, we're like at 3%, 3.5%, getting closer to 4% for some of the fixed rates. That's still relatively cheap. I mean, when you consider where rates are going, we're going to be at 5 and 6%. There will be a lot of defaults and a lot of issues. But if you have a strong cash flowing property, you run your numbers. By the way, if you run your numbers and your property can't cash flow at a new refinanced value, sell the property. It's garbage. You don't want buildings that don't cash flow positive. If it can't sustain a mortgage at a refinanced amount at today's rate and today's value, 80% loan to value, not what you bought it for, but today's value, if it doesn't cash flow positive, it's the wrong property. Sell it and buy something else. That's just always been my mantra. There's also something really like amazing about selling your portfolio and having a fresh, clean break. In 2017 and 2018, I sold almost all my portfolio and I went down like almost no rental properties, and then I exploded and did like 60 deals. But every time I sell and I get mental clarity, I buy again or I get back in a better way. Sometimes I do that with my stock portfolio too, where I'm just like, time for a clean break, and I'll just like close all my positions and rebuild my portfolio. There's some value to that. Taxes aside, there's some value to that. And I don't know. Alex Hormozi was talking about that, why he sold everything and just had like a mental clarity piece, and it just cleared up his headspace. There's so much value in that too. But if any time is to sell, it was 2 months ago, 3 months ago. The second best time to sell is now, in my opinion. So my rating on Canadian real estate and US real estate in most of the markets right now, talking about Florida and like a lot of the markets that are hyped up by low interest rates still, and there's a plethora of international and cash buyers that's drying. Like that plethora of a group of investors is a surplus of them. That group is drying up quickly. And you gotta remember, those cash buyers might be cash buyers, but they go and refinance the property. And when the numbers no longer work, they're gonna offer less. And when the property starts to sit, by the way, I've had people calling me now on buildings I was looking at in Florida, and they're willing to take offers that are lower than I was offering in March. So we're seeing it everywhere. Like, it's not just in Canada, it's in the whole developed world. It's worse in the US, and it's gonna get worse, for sure. That said, I just acquired a property in Florida. We acquired a property on 2 acres. It's like 3,000 square feet, has a guest house and a pool for well under 150,000 US. So there's lots of opportunities out there. Really excited if this project is going to be cool. It's going to be the first one, first sort of flip or so to speak in Florida. We might keep it. I don't know if we'll sell it or not. We'll run our numbers. Might be something we keep in Airbnb, and it could make a lot of sense. Is it because the cost base is so low, the downside risk it almost is not, right? The price we're getting it for. So where are those opportunities falling in your lap? Like there's this farm that I'm taking down. The offer, actually I have to call after this stream, I have to call my brother because he's meeting with the seller right now. He's sitting with them. And that's an example of another property that makes a lot of sense right now. I run the numbers and I'm like, okay, this is something I want to hold. Even if the market tanks back to last year's valuations, I feel good about this property. And again, cash flow positive stuff that the fundamentals make a lot of sense. The condo or the shitty areas of town get hit the hardest first, if that makes any sense. So if you've got a property in East London that's like bummy and was selling it like right around Fanshawe College as an example, that was selling for like $950, that's gonna pull back to like $750 and $700. It's gonna suck for those investors who are just buying on MLS 5 and 6 bedroom student rentals. They're gonna lose their shirt a bit. And they have no positive cash flow. They're losing money every month. So imagine to lose your down payment. Your entire down payment is gone now to what we'll call, it's not really depreciation, but I guess just like a slowdown in the market. And I guess you only lose when you sell, but if you're cash flow negative, how long can you be cash flow negative? And if you realize, hey, I could walk away right now, my entire down payment's gone, so why am I even holding this property? I have no equity in the game, no skin in the game. I'm losing money every month. Why am I gonna go deeper on these properties? So those kinds of deals will fall apart, and that will help add fuel to the fire. And once the general market says, hey, market's down 10%, and they start seeing the data, oh, it's down 20%, then all the FOMO disappears too. So there's a real potential possibility, and who knows, right? Market conditions continue to evolve, but there's a real possibility right now that we go into a bear real estate market, or a bear then flat real estate market for the next 3 to 5 years, potentially even like call it 2 years. There's a 99% probability that we will be in a recession for the next 12 months, and it may get worse. We are actually, by definition, by the NASDAQ year to date, in a recession right now. We dipped over 20% on the NASDAQ 2000. So that's across the board, a 20% drop in the market. that is by definition, we are in a recession. It's not, are we going to be in a recession? We are in one right now. Could it get worse? Hell yeah. We're down 20%. We could be down 40. It's happened. But you know what happens in the 120 to 150 days post a 40% correction in the stock market? A huge rally. These are the opportunities where you can go from being a millionaire to a multimillionaire, where you can go from 500,000 to a million. So there's going to be a lot of opportunities coming in the next few years. So again, I'm still strongly recommending stay in the markets, but where you can, refinance and trim and get cash ready to average down on those opportunities that present themselves, because there are going to be a lot. And for the last 2-3 years, there hasn't been a whole lot of opportunity. It's just been like blind appreciation and like everyone just made a bunch of money. So anyway, let's go to some Q&A because there's some great questions popping up here and I want to address them all. Live, can see, perfect. Good to hear. Hey, William, how you doing? Yeah, the TSX is not dumping near as badly. In fact, it had quite a bit of a rally because of what's happened with commodity prices. And remember, Canada in general is very natural resource strong, but run under poor management. So the NDP Liberal coalition is what I would argue bad management. And they have no interest in exploiting the natural resources in an environmentally friendly way. And they have no interest in exploiting the resources that Canada has. So instead, they'd rather it happens across the border worse, like with less environmental controls, and then pay to ship it at 2,000 liters an hour of diesel fuel to ship it in cargo ships back over to Canada. Like, retarded. Retarded. It is something that bothers me that we don't exploit what we have in Canada and bring it to market, because we could be a very, very wealthy country. We're huge landmass with a natural amount of, or an amazing amount of natural resources. And so there's a lot of opportunity here in Canada. So it's a real shame. I do love the TSX. I think that it's done very well. It will probably continue to be doing well. I don't see any huge growth here, but I see it being much more stable. So if you're looking for a stable, consistent return, a great place to put your money is in dividend stocks. The TSX is mostly commodities, natural resources, and financials, and a little bit of tech. Whereas the US economy is more of a service-based, a ton of tech. And so there's a bit more volatility as interest rates rise and there's volatility in the market. We could see huge swings of plus minus 20%. And so as an options trader, you could potentially do some strangles where if it goes up like crazy or goes down like crazy, you don't make any profit, but as long as it stays within a band, you can make a ton of money. So you can set those types of contracts up in a market like this right now and make bags full of cash. So if there's any good time to do options trading, it's probably now. In general, I'm just going to leave at this point for all those people out there who are like pro stock, whatever. One, I'll start with like, I have a finance degree, so I have an intimate understanding of company valuation. I've taken fundamentals of value investing. I understand TNA to a degree. I like TNA the least. So technical analysis, I think is the least reliable way to trade stock. I like to look at the fundamentals, the cash flow, the balance sheet, income statement, look at what it's doing now. I will say that you can almost count them on your hands, the number of traders that outperform the index, net of fees. And in the real estate space, your competitor is mom and pop, flipper who has a full-time job, who on the side is like renovating a property, or mom and pop, whatever, who runs like one rental property, or it just, the whole industry is not sophisticated. And there is so much opportunity for arbitrage. And a skilled person can get there and make a 300%, 400%, 500% return. Correct. Yeah, iron condors is one way to sort of strangle the stock price and make a great return. I see so many people take the Tasty Trades free course or pay for one of those courses that are out there. Baker, yeah, all my sessions are recorded. We have 4 years of weekly Wednesday videos. They're at least an hour each. So you've got 400 hours of me doing this kind of stuff every week, live Q&A. So you can go back and they're all recorded. You can watch them for free. They have no ads. I make nothing. My belief is that you continue to give. And if you give value, eventually you can make an ask of people, and you've given so much value that people want to partner with you on something, or they want to, whatever, right? So I haven't made my ask of you guys yet. I've just continued to give for years and years. And someday I'll make an ask. Someday I'll have a fund, or bring my business, probably a real estate fund or something, and say, hey, like, now I'm making an ask for you guys. I've been giving for 4 years. You've seen me. You've followed me for the last half a decade. I've done a decade of investing. Here it all is, laid out. I sell nothing, no courses, but here's my ask. Join me on this project or whatever. So someday I'll probably make an ask. But right now I make no ask at all. I sell no courses. It's just... Anyway, I want to make the point. If you're watching this and you've taken a stock options course, you will not beat the market. If you went to college for like general business and you took a stock options trading course, you are not going to beat the market in a 25-year period. You are competing against quant funds and small trading shops that have insider information, the best Bloomberg terminals, everything. They have analysts working 14 hours a day, and most of them have PhDs or specialties in finance that will take you decades to develop. And they spend 80 hours a week. Most of them get up at 5 in the morning and go till 6 or 7 at night. If you spend the kind of time that they spend, you can compete on their level. I spend an hour a day on my computer, usually my phone. I can't expect to beat the market over 25 years. If I get ahead of the market, I tend to divest and get back, I buy the market. Because I know that I won't outperform the market over the long term. So if you get way ahead of market performance, you compare yourself to your benchmark. If your benchmark's the S&P 500, if you're in tech, if it's the NASDAQ 2000, if you're building a dividend portfolio of like, commodity, utility, that kind of stuff, compare yourself to the TSX, Toronto Stock Exchange. It depends on what you're doing, but compare against the index that you're competing against in that space. And if your portfolio is outperforming the index, it's probably a good idea to trim the fat and just buy the index. In the long term, you will not outperform. 95% of professional Wall Street traders, hedge funds, mutual funds do not outperform the index. And they're the best. They spend all day with the best algorithms and the best technology and the best expertise. We cannot outperform that. We can get lucky. The stock monkey that randomly draws out stock picks has outperformed the S&P 500 many years in a row now. Blind fucking luck. It happens, but over a long enough period, it will not happen. So I'm just going to leave it at that. It's very, very hard to beat the market. And if you are beating the market, congratulations. Right now, this year to date, I'm beating the market. Last year, I was benchmarking against the TSX for the most part. I beat the TSX. Again, I shouldn't have, but I did. I know that's not sustainable. Right now, my tech side of my portfolio is down 19%. The NASDAQ's down 21%. On the other side, my dividend portfolio is more than half my portfolio, is outperforming the TSX. So on average, I'm down like, I don't even know, probably like 9% or something. I'm still beating the benchmarks, but I know it's not sustainable. I know that I'm not smarter than the smartest quants and hedge fund guys and the guys who you gotta remember, in the open market, it's very efficient, and there's opportunities to close these gaps really quick. Where arbitrage exists, you can close a gap super quick. In the real estate market, Granny lists her house for $100,000. None of the quants or hedge funds know about it. She put it up on Craigslist. One agent found out about it. If you've got connection, if I go call, and I used to at one point have like 50 or 100 agents that I would call occasionally and say, hey, you got any pocket listings coming out? Do you know of anything? Can I give you a couple $1,000s to refer me if I can close a deal? You call wholesalers, you pound the pavement, you get people bird dogging. That's a business. And you can exploit value in the real estate market doing that, right? You can exploit and uncover value. I can't go around and call and say, can I buy your Apple shares for $90 a share? No one's going to sell. There's an efficient public market. If it's trading 155, that's all you're going to get it at. Maybe you can write an options contract to get it like, 2% off, if you're willing to take that risk and insure the shares for the next 4 weeks or something. But there isn't the same amount of arbitrage and competitive advantage, I guess is the word I'm looking for. Like, you wanted to beat the market in whatever you're doing. You beat the real estate market, to beat whatever you're doing, you need to apply leverage and a competitive advantage. And a lot of us don't have any like a lot of us small time traders who are like, have interactive brokers on our computer or our phones and no staff. And it's like us doing it like 1 or 2 hours a day. And we read some news. We're trying to catch some cultural trends. By and large, we don't have a competitive edge. We get lucky occasionally. Maybe we make the right calls, but we will lose long term to the pros. But in business, it doesn't happen. I can go buy a Subway for half price. It's because it's not efficient. I can go buy a bunch of condos, and I did buy a bunch of houses and stuff like that that are 70 cents on the dollar. And the market might spend $100 to renovate, and I can do it for 70 or 80 or 90 and make that difference as well. Or I can go into a property and I get to be management. So I don't have to rely on management making bad decisions. As an example, like there are some companies that I follow that have horrible management, and they could be an amazing company with an amazing customer base, an amazing set of assets they could utilize way better, but they don't. The management makes bad decisions. In your business, in real estate, and whatever, in different other buckets that you can invest your capital into, you can make way more money because you're in control and there's a competitive edge you can build. So I'll just leave it at that. It's very, very hard to build a competitive edge in the stock market. Though I like to try, though I have fun trading, though I just made $220,000 today after hours on Facebook, thanks to calls and puts that I sold. I went balls deep. I love Facebook. At a 12 PE, I was like, the downside scenario here is I'm going to own a whole shitload of Facebook and have to hold it for 5 years until it comes back. But I'm okay to do that. WhatsApp, Instagram, Facebook. Those three platforms, I live on those platforms. Like Meta, and then they're expanding. And the metaverse is the future. We are going to just have like skins, and there's going to be so many NFT type clothing things that are going to exist in the metaverse. I think that where they're going, Meta has so much potential. I was hard for it at $250 a share, even harder for it at $200 a share, and today I went balls deep at $169.80 a share with options contracts. And I'm thankful it's 208 after hours, and it continues to grow. I will clear some of my position, but I will continue to hold Facebook. Extremely bullish on it. So again, I know that I'm not smarter than the market. They have a 12 PE ratio, or they did before the bump we just experienced, right? They're generating a ton of free cash flow. They don't pay a dividend, but they could. They're reinvesting that cash flow with a great return on assets, a great return on capital. Every dollar they reinvest back into their business is generating astronomical returns. Imagine businesses investing in Facebook ads. Facebook can invest in itself and make it's just anyway. You'd never always have diversity in your portfolio. Never go balls deep on one company. Try to have 50 names, 1 or 2% in every position. Diversity is key. I'm going to rebalance tomorrow. I know that I'm not smarter than the market long term. You're not either. If you're watching this, you're trying to sell some stock course, and I have a lot of people who do sell stock courses and think they're smarter than the market. And the worst part about these real estate gurus and business gurus, I see so many of these, like, not business, what's it called? Like marketing gurus, where they're trying to sell like how you help businesses market or something, like FBA and all that kind of stuff. And these guys have no experience and no track record. And they've like, for a year, they've been like selling shit on Amazon. And now they're selling you a course for $10,000 on how to do it. If you knew how to do it well, you wouldn't be selling a course on it. Like, anyway, if you're going to trade options, don't expect to beat the market. You can use options to match and benchmark the market and generate consistent cash flow and have a lot less downside and insure your portfolio against volatility. That's where options are super valuable. So I think it's important for everyone to have a stock portfolio. 1/4 of your net worth should be in a stock portfolio. Period. It's a great place to put 1/4 of your net worth. Don't go 100%. I mean, unless you have no interest in real estate or business or anything else, I guess do that maybe. But I think it should be at one bucket that you fail. And I think it's important to take an option trading course, because if you do, then you'll have an understanding of how put options work and call options work. And just the general knowledge is important. At a minimum, if you're worried about the market dipping and you can't sleep at night, you can easily buy some puts or sell some calls on the equities that you have and protect yourself against some downside, right? So that's a way to give up some potential future profit, but say, hey, I'm okay to not make 18% this year and instead make 10%, but then know that I'll never drop below 0 this year. Some people, if they're going all in margin or whatever they got going on in their personal life, they're buying a big property or something, it can make sense to do that. So it's a tool in the toolbox. It is very hard to go from $100,000 to $10 million using a stock portfolio. It's very, in my opinion, easy over a 5-year period, take $100,000 and turn it into 10 million in real estate or in business. You can grow exponentially fast and develop a competitive edge. You can't do that in the stock market in the same way. To outperform, like the growth you need to go from 100,000 to 10 million is like hundreds of % every year. You can do that in real estate. with leverage. I can take a deal and I can double my money with a 20% down payment, 100% growth turns my down payment into 500% ROI, right? Like a good deal where I could buy it for 100 and sell it for 300, put 100 into it, make 100,000 profit. If I did that almost all with cheap debt at 2 or 3%, with tenants in there covering the cost over a year period, I could turn that property around and my return on my capital that I invested is astronomically high. With, I think, the lowest risk exposure. You know, it's hard to really lose money in real estate in the same way that you can in the stock market. So there's just less volatility in real estate. And if you're buying the right kind of real estate, you're all good. All right, live Q&A lightning round. Let's get this pounded out here. Yeah, there are some cheap stock buys out there, so go ahead and look for those. What program would you use to mine crypto? So there are lots of them out there. Hive OS is a fantastic one that just is pretty much automated. You can do it on PC too. There's some other ones out there, but Hive is a good one if you're mining like Ethereum or Flux or whatever. Will says, I've been fasting on my summer cuts for years, completely underrated, and it's better for work-life balance, I find. 100%. I find if I eat, I'm slow after, I'm sluggish, my brain isn't as clear, my blood sugar isn't as great. So a number of reasons why fasting is just a great thing to do. Okay, next question. You're sounding like Ray Dalio. I've been calling this recession for 2 years now, and we've been booming. So I haven't been calling it for 2 years. I've been saying that prices are overvalued. In the real estate side, 100%, real estate is overvalued. It was growing exponentially faster than any supply-demand curves. It was growing because of stimulus and cheap debt. Let's not forget that in 2020, we're talking exactly 2 years ago, in Canada, in London, Ontario, in Toronto, real estate dipped 25%. Look at the monthlies. From February to May, we had a 25% drop in the price of real estate. That's a recession. I'm sorry, real estate went through a minor correction already. It bounced back quickly because the government pumped money into the economy and lowered interest rates to all-time lows. So there was a pump of money. But I was right. Like I was calling it in 2020 when COVID hit. I'm like, this is not good. By the way, at the bottom in May, I went and bought a dozen properties, more than that, 15 properties. So I went balls deep. When I see the writings on the wall that we're nearing a bottom, I start average cost dollaring in, right? Like I start getting in, right? This time is different than last time. Last time I started selling properties, and then at the bottom in May 2020, I was like, okay, I see value here. I start seeing there's ability to cash flow here. Rents went crazy. Minimum wage had gone up again. Rents were high. Rents are not up right now here. Prices are price to rents, way out. Price to affordability, way out. The big difference now to then interest rates were coming down. So people would qualify for bigger and bigger mortgages. In 2020 in May, you could qualify for a bigger mortgage than you could before. And there was stimulus money coming everywhere. Now, interest rates are cranking up. Lenders are tightening up. Qualifying rates are at 6% right now. Where you could qualify for an $800,000 mortgage, now you can qualify for $600,000. Where your cash flow was $1,000 for a building, it's now $400,000. Where it was zero, it's now negative $1,000. Prices have to fall unless interest rates come back up. Interest rates can't come back up. Inflation is out of control. They're in a rock and a hard place. So what happened before in 2020 to avert the last real estate correction, they poured gas in the fire and real estate went insanely crazy. It actually defied almost any fundamental analysis ever. It makes no sense at all. Like it was just completely driven by low interest rates and stimulus. And then the whole FOMO. People were fear of missing out, so they're just buying in, right, and speculating. That's going to dry up. So, and I could be wrong. I don't know. I'm hedging, so I'm still going to be in real estate. I'm not going to be fully out, but I'm looking for opportunities. Right now, there are some good opportunities in the market. It's a fact. If you want to buy right now, you can get a house for... I see houses that were selling for $1 million in Toronto. It's condos. They're selling for $1 million in the outskirts of GTA that are now selling for $799, or having offer date and nothing, $799. Whereas it would have went $200,000 over asking 3 months ago. That's a big difference. We're in a different market than we were. It's now a buyer's market. What will happen, and the rates haven't even gone up yet. People still have rate holds from February and March. Right? Like, you're not even going to feel the effects on pre-approvals and how much you can qualify for and the actual amount of payments for like at least a year. Like the latency on this is we're going to feel the recession 6 months or a year from now, right? So you got to think about how this plays out. Real estate is lagging way behind the stock market. If we have a crash, real estate usually comes after. Usually, or at least in the last decade or decade and a half, you got to remember that, and I'm just going to leave this fact out here. From 1990 to 2008, there was no appreciation at all. 18 years in Toronto, London. You had a decade. You buy a house in 1991, in 2001 it was worth the same amount of money. That's a fact. That can happen again. People are like, real estate always goes up all the time. No. I mean, we can have a 5-year flat period. That could happen. Guess what? If your model was buying single-family properties or duplex conversions, that in this market right now, almost none of them cash flow. If you're buying the $800,000 duplex in like, you know, Hamilton or whatever, like Brampton for 800 grand or 700 grand, or in Toronto for $1 million, that's barely cash flowing. When interest rates come up from 3 to 5, all of a sudden prices start coming down. You're not cash flow positive. It's not a great situation. And anyone looking to buy that property from you now has to qualify at the qualifying rate of say 5 plus 2 or 3, so like an 8 qualifying. Maybe they'll drop those stress test rules. I don't know. Probably they will. It wouldn't be smart if they did, because no one's going to be able to qualify for anything if the current mortgage stress testing rules continue to apply with these new interest rate hikes that we're seeing. So I think they'll probably ease up on those. But if they don't, or at least in the short term, it will create a huge amount of pain. Even people like, I'm fairly wealthy. I'm an 8-figure, entrepreneur or whatever. Like I have a good amount of money, and you might call me like, because I have people messaging me saying, hey, like the rich cash buyers are still buying. I'm like, I am the rich cash buyers, and I still finance too. Even if I put a cash offer, doesn't mean I don't still care about putting a mortgage on it after I'm done renovating it, or at some point in the future I'm going to use debt and leverage. Anyway, a lot of the arguments that I see right now that the real estate gurus are putting out there to be bullish on real estate, I'm poking holes in. And I'm like, okay, I think we're going to have a flat. We're going to have a drop, and then it's going to be flat for a while, and then another drop, and then it's going to be flat for a long time with a slow incline. It's not going to be like we've seen in the last 5-10 years. There were a lot of dumb investors, a lot of them, who bought a single-family house for $500, did nothing to it, did everything wrong, screwed everything up, and it was still worth $1 million in 2 years. They made $500,000. They doubled their money. Or if they put $100,000 down, then they did 500% on their money, and they didn't know a damn thing, and they didn't know what they were doing. There was a lot of that, right? That's not going to happen in this market. With interest rates higher than they were before, it's a lot harder to succeed. But the pros will still succeed. You can still build a business. And yes, financing is important. People message me like, oh, rates don't matter, man. Like, there's so many cash buyers. That's not true. The rates matter. It's going to have impacts on businesses. It's going to have impacts on real estate, and there will be opportunities to buy. I don't know how far prices will come down. We still have a supply-demand issue. The government is investing heavily in increasing supply. With interest rates cranking up and inflation at all-time highs, the inflation piece and supply chain issues, they're working themselves out, and they're coming down. But in the short term, that also puts pressure on new builds. So we're still going to have the supply-demand issue. So there are some bullish factors for real estate, sure, which keeps it from dropping, it keeps it sort of sticky. Doesn't let it drop too hard. It's not as volatile as tech, where you'll see a 47% drop in the span of like 45 days. You're not going to see that in real estate. It's going to be there's going to be a lag of several months, and it's going to be not as bad, not as exacerbated. I put my kids to bed. I started the stream late tonight. We're at the mall looking at, we went for food and with the kids to the mall, and I was late for the stream tonight. And then the stream wasn't working for the first 10 minutes. So I got to wrap this up. I have like 5 more minutes. I'll do like one more question here. What are your thoughts on Sarnia? So Sarnia is just this question about strong cash flow. And Sarnia, I just read the whole question about cash flow. So if it's cash flow positive, you believe in the property, you want to hold it, cool. At the same time, Sarnia has creeped up a lot. And Sarnia is at the same time, Sarnia is very tied to petrochemical industry. It's the armpit of Canada, at least the armpit of Ontario, I would say, in the top 2 of armpits. The smog is just horrible there. I grew up in Sarnia, so anyway, Sarnia is a rough town. It's got some rough people, mostly blue collar, but oil and gas is up right now, so the plants are doing very well. Prices have skyrocketed in Sarnia, more than they even have in London, especially recently. And the market is still strong for now. Interest rates will affect the plants too. It will affect everywhere. 6 months, a year from now. Not right now, but in the future, it will affect things. So if you're planning on the house being worth 300, just say, do I still want to own this house if it's worth 230? And if you're buying it right now at 220, you might not make any profit, but at least you're not going to lose any money. You came in at the right price, and if you're cash flow positive, say $1,000 a month or something, say, hey, if rents came, because rents in Sarnia right now are crazy. I have heard that and continue to see that. If there's less demand for rental units, like it was 2 years ago in Sarnia, and rents went from $2,200 for a house down to $1,700, do you still cash flow positive? And if the answer is yes, and you can survive a refinance, stress test, et cetera, so forth, and you're okay with the valuations dropping potentially, hold. Hold the property, make your cash flow every month. It's a good little part-time gig. Real estate is an amazing business, an amazing part-time gig. And if the market stays flat, and you can make some money, maybe it doesn't drop, and you can still make some equity and repair it and build it up, there's definitely opportunities for making money. So I'm still bullish, but yeah. Oh, so J-Do says, how is it a buyer's market or average months inventory? So if you look at the listings right now, and you look at all the listings that are have offer dates, the majority of them in London, in Toronto, all around are missing offer date, where they were getting 10 offers before. What we're going to see, people are canceling them and then putting them back on. I did it too. So the days on market would not be huge on your listing. It's a smart thing to do to keep the days on market low. And we're seeing a lot more of that where we weren't before. I have properties on the market right now, and I've talked to about 20 agents so far. If you look at some of the comps in certain pockets of Oshawa, as an example, in Oshawa, there was a condo complex that was selling for like, you'd list for 800, it would sell for 1.1. There's one listed right now for 799, no offers. You can probably get in there and offer like 780 and get the deal done, right? Where before you would have to pay $1 million. So there are pockets that are depressed. Yes, there's a shortage right now. Some people are still afraid of COVID. Anyway, there's definitely, no, definitely not. Like it rents up for $10,000 a month, right? So my mortgage on it's like $5,000. There's so much cash flow there. We're not talking about me being like $100 a door. I've got like several $100 per door times 6 doors. So I can afford to hold. I don't need to sell. The right buyer will come along. There will be a buyer who wants just a nice, clean, legal sixplex that's everything's ready to go, fully renovated, perfect, turnkey rented with management in place, who will give me the price that I want. I know the price I'm asking is February. I'm at the February pricing, and I would have sold no problem then. But we're not in February right now. So I gotta lower expectations. Prices are falling, right? Rates are going up. So yes, it's not what it was before, but the market is such that there isn't the same demand that there once was. So supply, you're right, might not be creeping up a lot, but it will continue to increase, especially once some of the investors realize that the prices are going down, because people don't realize that yet. Yeah, so my forecast is not bear, neutral. I would say I'm neutral on real estate. I'm not bullish on Canadian real estate prices right now. There are certain properties that I'm bullish on for sure. Waterfront real estate, as an example. Okay, super chat. 2 of them, thank you. Will says, you're the most selfless entrepreneur I've watched. Thank you so much. I appreciate that. A lot of people on here are just going for the free money, or the easy money, the cheap money. I'm looking currently not to raise any capital. There will be a time where I'll ask that of you guys, but for the last year, I have no interest in raising any capital from you guys. No interest in selling you guys any courses. Just giving for the sake of it. I don't even have monetization turned on. This super chat is all I'm making, $7. Whoopee shit, I spent $10 on a smoothie today. Or I'll probably spend it tomorrow. Sorry, I guess Jonas actually bought the smoothie for the kids. So he treated us to the smoothie. Thanks for that. Fred says, sorry, joined late. Updates on the Millionaires Club. It exists. We have a group on Facebook that's private and exclusive that has a group of people who have about collective $500 million in net worth, or $500 million in our little group. And my goal is to get that group grown so that we have $1 billion in collective capital, and we can do some cool shit, buy some resorts in Costa Rica, Bahamas, Canada on the water in the Muskokas or something, or on Lake Huron, maybe a couple other exotic countries, one in Europe, and we pull together and buy some resorts in all these places. We have some sort of membership club where it costs us almost nothing to be part of it. We can have some cool masterminds all around the world, and it's all tax deductible. That is one fantasy that I have for this group. No, collectively in this group, we've got about $500 million. There's not very many people in this group, like under 200, I think, right now. But if you collectively add our net worths together, we have $500 million of power. And it'd be cool to get more people in there that have like a 5 or 10 million net worth or whatever, or maybe even someone who's got 50 million or 100 million net worth, get in there and really grow the net worth of the group. Okay. I gotta go. Elisa's like raping my phone right now. She's like, hey, get up here. Kid's bedtime. The economist expert gave a comment that I like this guy. He thinks from principles first. I like that. Thank you for that comment. Much appreciate that. A lot of the people out here right now are not analysts and don't come at it from an analyst background, don't have any analyst background. A lot of the real estate investors you meet are like high school graduates or worked in the trades. A lot of plumbers, strangely, own like 6 rental properties, or like electricians I meet and stuff, that they don't have the same pedigree that an analyst would. And they don't look at things from a macro perspective. They're looking at like talking to one realtor or like, I don't know what they read online, maybe, I don't know. So I noticed there's not a great number of Canadian real estate gurus who come at it from an analyst approach. You know who's a really great person to follow? Ex-mentee of mine, good friend, Austin. Check him out, Austin. Yeah, he's gives us some great content. He comes at it from the same approach I do. We think the exact same way. So big call out to him. If any of you guys follow, I think that's his name on Instagram. I forget his handle. I thought it was Austin. Yeah. Anyway, message Austin. Tell him I shouted him out. Follow his content. His shit's legit on Instagram and mine at Mike Rosehart. Thank you, William, for the $10 super chat. Appreciate it. Wrap this one up. We'll talk next week. Everyone knows where to find me on Instagram, Mike Rosehart, and on here every week live. All right, I gotta do the girls' bedtime. So thank you so much for watching, everyone. The secret to unlocking a wealth through you is returns. Thanks, everyone. Have a good night. We'll see you tomorrow. No, next week, Wednesday, 7 p.m. Eastern, and on Instagram whenever you guys want. I do stories 10 times a day.